Welcome, everyone. Thank you for joining from around the country for this week's Pro Perspective, an insider's look at all things commercial real estate. I'm your host, Yannis Papadakis, Business Development Manager at Crexi in our auction department. Today, we have a very special guest. We are zoomed in with Armond Aivazyan. Armond is located in the founding Palo Alto office of Marcus Millichap. Armond assists his clients in the acquisition, disposition, and refinancing of single-tenant net lease properties. He advises his clients on successful acquisition and disposition strategies to maximize cash flow and disposition value. Armond has successfully closed on numerous 1031 exchange transactions with clients seeking management-free passive income from national tenants with strong credit. Armond has closed on categories of tenants ranging from restaurant, drugstore, bank, auto, government, discount dollar store, convenience, home improvement. Notable tenants that he's closed in these categories include Raising Cane's, love their chicken, Panera Bread, Wendy's, Taco Bell, Walgreens, SunTrust, US Bank, AutoZone, Dollar General, just to name a few. The list goes on. Armond graduated from the University of California, Riverside. He is a member of the International Council of Shopping Centers and is a licensed California real estate agent. Armond, welcome to the Pro Perspective.
Thank you for having me. I'm very happy to be here.
Now, a little bit of history here. Armond, I actually, I know you from Marcus Millichap because we used to be partners at Marcus together in the downtown LA office. Isn't that right?
That's right. That's right.
And so I know firsthand exactly how thorough and diligent you are when looking at net lease properties. So I thought, who better than Armond to bring on to, give us a course on what to look for and how to evaluate these properties, as there has been a pretty high demand market-wide, an increased demand for net lease properties, both because of the management-free nature of them and, depending on what market you're in, you may be exchanging into a market where you can, get a better return. Now, something that's not included in your bio that I want to ask you about, you were actually a rock star salesperson before you even got out of high school, and you were given an award for selling. Who gave you that award? Tell me a little bit about that.
This is going way back. Into high school, I was actually a power seller on eBay. I was buying wholesale items and listing them for sale on eBay. And that's where my sales history started. So that's really, really going way back.
So you were an extremely early adopter of the online marketplace model. And you were crushing it back then. eBay actually sent you an award in the mail because of how much business you were doing on their platform.
I still have it. Yeah, it's a nice certificate.
Wow, that's awesome. Now, it comes as no surprise then that you were actually the person that introduced me to Crexi. While we were working together at Marcus, you said, hey, here's this new platform. We got to get on here. It's beautiful. All the tools are really cool. And you actually were the one that introduced me to Crexi. And here I am.
Yeah, I love the platform. I remember Matt Kors had reached out to me a number of years ago, and I just love the platform and been on it ever since.
Nice. Well, today we're going to be talking a little bit about net leased assets, retail in general. And so why don't we just dive right in. Before we do, as a quick logistics reminder for our viewers, there is a Q&A box and a chat feature. If you can ask questions in the Q&A box, we'll try to answer them a few different times throughout the show. And with that, let's get the conversation going. Now, Armond, give me a little bit of background on how you got into commercial real estate and your path getting into net leased assets.
Sure. Graduated in college back in 2013 and thought I was going to go to law school. I started working at a law firm, decided that's not what I wanted to do, and thought I'd just jump right into real estate. Got into commercial real estate. Marcus Millichap was the first firm that I interviewed at. I remember my manager was looking at my resume and he said, there's no real estate experience on here, but I'm going to give you a shot. And I'm glad he did. And that was back in 2014 when I first joined Marcus Millichap. And I started working immediately on net leased assets. only because I think there were so many apartment brokers in the office at the time. And I told my manager that I was interested in the stock market and following various companies and retail trends. So he pointed me in the net lease direction. And I started working on a team in the Los Angeles office, and I started working on net lease bank assets at first, and then slowly expanded out and started working on all various categories. I built a team in the Los Angeles office, and now I've moved up to Palo Alto, where my office is right now.
Nice. Now, I know that from experience, while we were in the office, you were constantly, consuming, business news, retail news. Were you consuming that prior to getting into net leased, or did you start paying attention to that sort of thing afterwards, or had you always, kind of had your nose to the ground looking for information in that market?
I definitely started looking at companies and their financial statements more critically and how it relates to real estate. So was looking at companies prior to it, but definitely more critically after getting into the net lease space and after having to review company balance sheets and looking at their assets and liabilities. So definitely more critical after getting into the net lease space.
And for our viewers that may have zero experience with a net leased asset, can you explain what a net leased asset is?
Yes. So a net leased asset is a single tenant building. It's one tenant, one lease, one building. And a good example would be a fast food property that is leased out to a tenant such as Taco Bell, and they have a long-term lease, and that lease may either be a triple net lease or a double net lease. The idea is that they pay the rent to the landlord, and the tenant takes care of all of the expenses in a triple net lease.
Got it. So generally speaking, what you're looking at is different lease structures where the tenant is assuming some or all of the responsibility of the property. And then you as the landlord, you're just collecting the rent, but depending on the lease structure, you may have some landlord responsibilities there.
That's right.
Can you go through the differences between, double net, triple net, the different types of leases that are common to find in the marketplace now?
Yeah. So with the triple net lease, the tenant is responsible for all repairs and maintenance, which include roof, structure, parking lot. Tenant is also responsible for the insurance and the taxes and the utilities, essentially responsible for all expenses. So when the landlord gets their rent check every month, it's net rent and there are no expenses. And this is with the true absolute triple net lease.
So if I were an owner looking to buy something that's truly management free, I'm looking for an absolute triple net property.
You are looking for an absolute triple net property. Yes, that is correct.
Now, how does that differ? And I see oftentimes, a double net property will have a higher return or a higher cap rate. What's the trade-off there? Why am I getting a better return for a double net than I am for an absolute triple net?
That's a great question. So with double net properties, an investor can expect a return of anywhere between 10 to 25 basis points higher than a triple net property. And that's mainly because the landlord is going to be responsible for maintaining the roof and the structure. So some landlords are more willing to take that on, that extra landlord responsibility to be compensated for it in the cap rate. And additionally, there are some tenants that investors do prefer that only sign double net leases for the most part. They may have a few triple net leases out there, but some good tenants for this example are Sherwin-Williams or Tractor Supply, where they're excellent tenants and have great credit, but they are for the most part double net leases.
And is that just a business practice preference for them that they just don't want to get in the business of dealing with the real estate, so they structure double net leases?
That's correct. Yes, they prefer for the landlord to take care of the expenses, and there might even be a clause in that particular double net lease that says landlord takes care of the expenses, but will pay for whatever that expense was or that work that that landlord did via additional rent.
So they'll reimburse it via additional rent. They just don't want to have to be the ones to, call the contractor, bring him
That's
out,
right.
quotes, do all. And I understand that too. If you're, Sherwin-Williams, you're selling paint, you know, you're not property managers per se, even though you do, lease a lot of space. So I guess what it comes down to is preference. If you're an investor, whether or not you want that total hands-free, absolute triple net property, or, you don't mind, a little bit of management responsibility for that additional, cash flow, that higher return you're going to get.
That's right. That's
Interesting.
right. Yes.
Now, what are some factors about single tenant net lease deals that, most brokers or even investors, don't consider or may not know?
So factors that they might not know regarding a triple net lease. Well, you really have to read the language in every lease structure. Although the lease might say that it's triple net, you definitely really want to go through the language. We recommend all of our clients to hire an attorney to help them review the lease, because there can be language in there that says, for example, although it's a triple net lease, in the last 2 years of the lease, if there is enough damage to the property, the tenant might have the ability to terminate that lease and walk away. So these are all small facets that are important, that need to be reviewed very carefully in leases.
So I don't think we can overstate this enough. When evaluating a triple net property, the holy grail is the lease itself. You got to read the lease. It could be marketed as a, absolute triple net property, but once you dig into the lease, there may be language in there that, specifies otherwise. There may be some caveats here and there. And so the only way to be absolutely certain that, you're getting an absolute triple net lease is to dig into the lease and read all the language. Is that right?
Yes, you have to read all the language. Again, recommend having an attorney alongside reading the language and letting you know of any potential pitfalls in that lease, because no two leases are the same. And depending on the time where that lease was signed, whatever deal was reached between the developer and the tenant, there might be a clause in there that you really have to look out for, and make sure you know what you are getting into.
So two things that pop up that come to mind for me when we're talking about looking at some of the details of these leases. Number one is going to be sales, right? Whether or not the tenant is reporting sales, if they have to report sales to the landlord. Obviously, if you've got a lease where the tenant reports sales, you want those sales figures so you can understand how they're performing. And the other thing that comes up too that I think a lot of people don't consider is assignment language. Can you talk a little bit about how assignment language plays into how you're evaluating a lease?
Yeah, that's a great question, and that's actually a huge point in leases, because there might be an assignment clause. There will be an assignment clause that will have provision saying who the next tenant, the current tenant, could sublease out to, and things you want to look out for in those clauses are if there is a financial language in there, and it's not just a blanket assignment that says the tenant can assign this lease to anyone in a similar industry. You want to look for language that says the tenant that's being assigned to has to have a certain financial backing, and they have to operate certain units. So even if they do assign that lease, the sublease tenant will have the similar credit or financial backing as the current tenant does.
So you're telling, so just hypothetically here, let's play with this situation. So I want to buy a 15-year Starbucks triple net. I buy it at a 4 cap, which is a great deal if it's in Southern California. And if I don't dig into the lease, right? It could have assignment language that says, hey, next year, Starbucks can decide to assign this lease to, single unit operator, Long John Silver's. And now instead of a 4-cap Starbucks, I've got a 14-year Long John Silver's with a single unit operator, just a franchisee. That can happen.
That can happen if that language is in the lease. Typically, they will like to keep it a little bit more in the same category. So the language might say we have the right to assign out to a coffee type tenant.
Okay.
But the example, the hypothetical you brought up can happen if that is in the lease.
So extremely important, not just digging into the lease to know exactly what you're buying, but to dig into the lease so that what you're buying stays what you're buying over the course of the lease.
Absolutely. And I think one portion of the lease that also gets overlooked sometimes is the insurance requirements. Because although property can be absolute triple net, the tenant's insurance requirements, I remember I was looking at a property that was in the Midwest. It was a fast food property. And the insurance was just so light where the only thing that the tenant was responsible for was essentially fire and maybe up to $800,000 into the property. But this is a $2 million property. If there are any other acts of God, or if there's anything else that's not covered in that lease, then that's a huge pitfall that must be avoided. And it gets avoided by thorough reviewing of the lease.
Now we've got a couple of questions that have come in. Again, if you have any questions, please use the Q&A function of the Zoom. First question comes in from Serena Olshan. Do you have any experience with zero cash flow triple net leases, and how do you value that?
That is an excellent question. Zero cash flow leases are like a CVS property. CVSs are very notorious in the space where at the beginning of the lease, where a 20 or 25-year lease gets signed, there is a self-amortizing loan that gets placed on the property as well. And that loan gets paid off at the end of the lease as well. So by the time the lease is done with that credit tenant, the loan is paid off. And there are many benefits to this that we tell all of our investors to confirm with your tax advisor and with your CPA to make sure that this scenario works for you. But essentially, the property has so much debt on there where all of the rent payment that is coming in is paying down that loan. So the rent payment is the loan payment. And what this does is it creates a tax shelter for many investors. It's a loss that they can carry against their taxable income.
Got it. Thank you. And then in terms of valuing those, how do you go about that? I mean, since you're using it as a tool for your taxes, help me understand, what are you looking at when you're evaluating it?
Well, the number one thing that you have to look at with zero cash flow properties is the down payment required, the equity required to enter that lease or that deal, that transaction. How we value it is there's a market cap rate, just like any other asset for a zero cash flow deal. And they're valued essentially with how much down payment is required to enter that deal.
Got it. Now, next we've got a question from James Carter. James asks, how does the age and condition of the property affect the decision for a tenant regarding triple net versus a gross lease, so to speak? And to add to that question, are you typically seeing that these triple net leases are always accompanying new development? So it's a brand new building, which is why it's getting an absolute triple net lease, because the tenant is saying, hey, they literally just built this thing, so I probably don't have to worry about much.
That's an excellent question. So one great example is with Dollar Generals. So if a brand new building is being built and constructed for Dollar General, they will sign an absolute triple net lease. At that point, Dollar General really doesn't have a issue signing the triple net lease. It's a brand new building, so they're interested in signing that lease. But now, if you bring them a location that's in a dense infill market, that doesn't really allow for brand new construction, and it's an older building that they have to backfill, that lease will most likely be double net, because the tenant does not want to deal with the repairs and the maintenance on the older structure. So that is definitely consideration. One other point that I would like to add is it also does depend on the location. There are some tenants that are willing to sign a as-is lease on a building only because the location is so excellent. So they're willing to take on some more responsibilities at that point.
Great. Keeping the questions coming. We've got from Clarence Kundif. You mentioned good pitfalls in triple net lease clauses. What are some pitfalls for ground leases?
Pitfalls for ground leases.
First off, before we go there, why don't we just give a quick overview, ground lease versus triple net, broad strokes.
Absolutely. Quick explanation, ground lease, piece of land that an owner owns and they lease it to a tenant, and the tenant builds the property themselves, and they own the building and they depreciate on the building. The landlord owns the land underlying the property.
So I'm the owner, I'm the landlord. I've got a ground lease with McDonald's. They build a McDonald's there. McDonald's owns the building. They can depreciate the building. I collect rent on the land. I cannot depreciate the building.
That is correct.
Now,
that is correct.
Once the lease is over, right? Let's say the lease is done. One pitfall I know of is the take the building with you one, which may be good or bad depending on
the age of the building. Yeah. That is a clause in a lease where a tenant may have the right to raise the property and completely remove it and give the property, the land, back to the property owner in the condition they got it in. That's a little bit more of a rare clause because there's a lot of cost associated with raising a property. But for the most part, they will provide the building back to the landlord in broom swept condition with normal wear and tear, and the landlord can do as they please with the building. And so some of the pitfalls with the ground lease. So I like a ground lease scenario because there are virtually no landlord responsibilities at all because you don't own the building. But some of the pitfalls, if you may, are less depreciation or no depreciation. I did sell a Home Depot last year that was a ground lease. For that property, however, the owner did get a cost segregation analysis done where they had a tax engineer and a cost segregation engineer go out to the property. And Home Depot is on 10-acre lot. So that is a lot of asphalt and parking and utilities and landscaping that you are still able to depreciate on, although you're not able to depreciate on the building because you don't own it. So depreciation is a major downside in the ground lease scenario.
Great. Now, we're starting to get inundated with questions here, so I'm going to try to group them together to save some time. Great question here from Andreas Lopez. Number one is, how do we position our clients to prepare for lease negotiations when the lease comes due? Number two, should we as brokers be highly involved with this process or not involved at all? What's your take on that? Because I know that can be pretty stressful for an owner if they know, hey, I've got 3 years left on this, initial 15-year triple net lease that I bought. It's, something's going to happen here. When do you start making moves? Do you start, do you wait to hear from the tenant first? Are you proactive? What's your philosophy behind this?
I think it is a case-by-case basis. It depends on what the relationship has been like between ownership, landlord, and tenant. If it's a location where the sales are extremely high, the traffic is extremely high, then in that case, the landlord really does not have to go to the tenant and ask for an early lease extension. At that point, it would be in the tenant's best interest to reach out to the landlord and to begin that process, because they know that this is such a great location. We need to secure this, and we need to do everything we can to keep this location. Now, on the flip side, if it's average or below average performing location, and there are a few years left in the lease, then the landlord can still reach out to the tenant to work out a negotiation. But at that point, the landlord should have knowledge of market rents, and just be prepared in the event that the tenant does ask for a rent reduction. The landlord should have compelling data and research to show why the market rent should be whatever the landlord thinks the market rent should be. And the other part of that question was, do we reach out on behalf of our landlords? And I think a good answer for that is, if you are experienced and knowledgeable in this space, where you feel you're comfortable enough to represent your landlord on that, then you are able to. We reach out to tenants on behalf of our landlords when we do have listings, and we do discuss rent negotiations and lease extensions.
So it sounds like what you're saying is the heavy lifting for understanding how to approach lease and negotiation should be done long before then, in understanding, number one, the location, just the real estate itself. Tenant agnostic of the tenant, you should know that you've got either good traffic counts, convenient ingress and egress, all those real estate fundamentals that you're going to want anywhere for any type of tenant, corner location, signalized locations, ease of access. And then add to that, right? How much do you know about the tenant's performance? If they report sales and you can, get an annual sales report for them, and that they're, crushing it in sales, then you probably don't have too much to worry about, as they're going to probably want to stay there operating. On the flip side of that, if you don't have an indication of sales because they're not reporting sales, then you kind of have to piece together different data points about the overall health of the asset itself, like the demographic, the population density, traffic counts, all those things, to try to come up with enough data to arm yourself for that kind of negotiation.
Yeah, that's absolutely correct. And a lot of leases do not report sales. A lot do. It just depends on what that lease is. But if that's information that you do not have, it's going to be that much more difficult to know how the store is performing.
Now, another question coming in from Rob Singh: who's the ideal buyer for STNL properties, single tenant net lease properties? Cap rates are so low. Who's purchasing them? Are they all cash buyers, REITs, family offices? How does debt play into this? Cap rates are so low. How does an investor get their return? Rab, I feel you.
Excellent question. And all the buyers mentioned in the question are all buyers in the market today. Right. We do represent private individuals, family offices, publicly traded REITs, private equity firms, even developers. So there's buyers all across the spectrum. Most of the buyers that we do work with are 1031 exchange buyers. And a large portion of those buyers are people who sold an apartment in, say, California. My office is in Palo Alto, and the apartments that are being sold in this market are, anywhere from 1% to 3%, very, very low cap rate sale transactions. So when they're looking at a 5 cap Raising Cane's in St. Louis, that cap rate, that cap rate arbitrage is definitely an incentive for them to exchange into those properties.
And I mean, I recall, quite a bit when we were working together at Marcus, we were seeing a lot of a pretty big delta in cap rates between Southern California apartment sellers and available triple net properties out of state. It seemed like 3-4 years ago, we were seeing apartment deals go under contract, sub 4 cap, sub 3 cap. And then these people could turn around and buy, 15-year Hardys, at a 6.5 cap, right? Or 6 3/4 cap, something like that. So I think what you are seeing is, a lot of people that are chasing that yield that want to get that better return. But to add to that, just the attractive lease structure of, a triple net or a net lease property. Appreciate that. Thanks for the question, Rav. We've got another question from Serena Olshan, and this is on, again, coming to valuation. So after the initial period of a lease, how are you evaluating those? Let's say you've got an initial 20-year lease and now you're in, 4 or 5-year extensions and you're in that first set of 5-year extensions. Are you only evaluating it for that 5 years? That's the only guaranteed rent at that period. Can you talk a little bit about that? And does it behoove a landlord to push for a new initial term as opposed to riding those extensions?
That's a great question. So the way that it is evaluated is if a property has 4 years of lease term left, we are looking at similar assets that traded or are on the market or that are under contract that have similar lease terms, and there is a market cap rate for that, however much lease term is remaining. Does it behoove a landlord to reach out to the tenant and get a lease extension prior to putting it on the market? If they're able to, and if it's not going to be at the cost of a large rent reduction, then yes, absolutely. A asset that has 10 years more term.
What's the there's got to be a balance there, right? So, on how much rent do you concede for how much additional term? And that's something that you should really work with a broker on so that you can maximize your exit, right? Because if it means trading a little bit of rent up front for more term, that hopefully equates a lower cap rate as well. So you'll get that money back on your disposition.
That's right. And it's not always the case that it's going to be a rent reduction. There could be a location where the rent is already so low where the landlord might not want the tenant to exercise that option period because they know that they could get another tenant in there who's going to pay them more. So in that case, that landlord would put the property on the market with 3 or 4 years left. And the main investment highlight would be that this is a below market rent. So in this case, you don't want this tenant to renew the lease and you want to get someone else in there at a market rent.
Right. All right. Now, I want to shift gears a little bit here to what I'm sure a lot of people tuned in for, and that is, let's get a bit of an update. How has COVID changed things? And I mean, the marketplace has been affected by COVID in pretty much every product type. I'm sure that's no different with triple net. Why don't we just take a quick overview? Tell me, what are you seeing? What are you hearing? What changes have you noticed in the marketplace since things shutting down in March and since the pandemic outbreak?
Yeah. Well, when it first, the lockdown started happening in March, a lot of the feeder restaurants and quick service stores that we had recently closed on, we were getting notices that these stores are not going to be open and landlords are starting to get rent reduction and rent relief notices from tenants. That period has cooled off. It's something that we were dealing with from about March until 3 months, 4 months out. But I think some of the panic has definitely gone down, certainly not at the level it was in March, but a lot of the experimental real estate has really taken a hit, such as casual dining, sit-down dining, the movie theater space, hobby stores, clothing stores, anything that is not a essential tenant has really taken a hit in this market.
So non-essential has taken a hit. Where can you name a couple of essential tenants that before COVID maybe weren't getting, the kinds of looks that they're getting now? I feel like if you're an essential business right now, pre-COVID, if you weren't, you're the prettiest girl to dance now, right?
Absolutely. Dollar General, all the dollar stores. I mean, they were doing well before this, but all the dollar stores are definitely getting a very close look in the market today. Some of the drug stores were some investors might have seen them as too large of a property, and concerned that Amazon is getting into space and they might not want a 15,000 square foot building. But now drugstores are definitely something that investors are considering today because they are an essential tenant, and they have paid full rent during the pandemic. Drugstores, dollar stores. Sherwin-Williams is definitely on top of the list for a lot of investors. Paint is something that is not sold or shipped. Yeah. Yeah. And it's not something that you could buy online either. You can't ship paint. Yeah.
Yeah, you got to go to the paint store to get it. And I think that when looking at triple net deals, generally speaking, looking at what's happening in the market, in just the overall market, and then on a micro scale, what's happening in that market can really inform a decision significantly. Can you talk a little bit about where have collections hurt? Are there specific tenants or types of tenants in triple net that are particularly getting beat up right now?
Yeah, the casual dining sit down space has definitely taken a hit. We recently closed on a large casual dining store in February, and when we were looking at this asset, there's a movie theater next door, and it was part of a large shopping center. So the investors said, "This is excellent,
all
right?
Great fundamentals for
Great
retail.
fundamentals.
You want restaurants to be where people are.
You have a movie theater right across the street from the restaurant. So the movie theater closed down. The casual dining restaurant also closed down. What's that?
Was it a Regal by chance?
Regency Cinema.
Regency.
I believe that one was. Yeah. Yeah, all movie theaters have taken a hit. It's no one spared in that space, unfortunately. It's so a lot of the sit down dining, and a large part of that is because they're not. When I go down to the downtown over here in Palo Alto, there are restaurants that are regional tenants that are able to open up outdoor dining and get creative. But when you're operating 700 locations all across the country, it's very difficult to connect with all those different cities and ordinances and find out if you can do outdoor seating or not. So a lot of casual dining has had to reduce or completely close their doors and reduce only to takeout or delivery.
Yeah. Yeah. And it's not the kind of thing that you could have predicted, just as you say, you found a great location, next to a city center, all these other amenities that are right around it. And then, the mere fact that humans can't gather is what is keeping it from performing as it should. Can you talk a little bit about what protections, we got a question from Bobby Jean. What protections for owners should be in bankruptcy clause? Least protections needed.
Thanks, bankruptcy clause. So leases do have clauses for bankruptcy. Essentially, if the tenant is in default, you really have to follow the lease to see what remedy that you as a landlord have. If they are in bankruptcy, you have to go through whatever receivership or bankruptcy law firm that tenant is being represented by. So if a tenant has filed bankruptcy, you have to reach out to their attorney's office for any type of collecting rent or wanting to exercise any of the default clauses you have in your lease. And at that point, I definitely recommend for that investor to hire an attorney who will reach out to the tenant's bankruptcy attorney to request whatever it is that the landlord is requesting.
Got it. And I mean, with COVID and with a lot of locations currently not operating, are you seeing that at least these corporate backed locations, even if they're not operating, how are collections looking? Are they still paying the rent? And if not, what remedy do you have as a landlord right now? I know there are eviction protections a lot of places for tenants that aren't paying rent. What does that look like for triple net properties?
Yeah, so for the most part, collections are looking much better for single tenant net lease properties. I don't work with the shopping center tenants who are still may still be struggling, local and regional tenants who are still struggling and working with their landlords. But for the most part, all the nationals negotiated their rent relief starting in March for April, May, June. So we did see a lot of 3-month agreements that got placed or deferral agreements that were reached. But as of now, most of the tenants that we are working with have gotten current on their rent or reached a rent relief agreement with their landlord.
Interesting. And I've got another question that's come up here, and this is actually a really interesting one from Matt Coletta. Can you please discuss the timing game with triple net properties on when to get out or sell? For example, an investor purchases an absolute triple net fee simple QSR with 15-year lease with options in a great location, high vehicle count. Let's just assume sales are good too. At what point should the investor look to sell that property? When the lease gets under 10 years, question mark. What is your thought here? And I know that before you answer, you're going to say, well, it's going to depend on what the goals of that investor are.
That's right.
Let's take a look at it from two goals. Goal number one is to secure cash flow, just very passive, secure cash flow. Goal number two is to grow wealth.
Excellent question. So we're dealing with that right now where we represented a client on a purchase of a Raising Cane's property back in 2015. And 5 years has passed by. And now it's at the point where there's 10 years left on the lease, and Raising Cane's has just had a 10% increase in their rent. So now there's 10 years left on the lease. There is higher income. So the landlord is now selling that property. And 10 years is a great time to consider selling your property if that is your goal, because a lot of lenders do like to see at least 10 years of term on the property. Of course, lenders lend on properties that have less than 10 years left, 5 years left. But typically, if there's at least 10 years left, an investor is going to get much better financing terms. And so you will have a much larger buyer pool for a 10-year term. So 10 years remaining is a good time to place the property on the market. And the other part of the question, generating wealth. So that landlord who is selling the property now does have a gain on the property, who will be exchanging into a larger asset that will have more cash flow, more principal pay down, and a renewed depreciation schedule with a longer lease term.
So it sounds like if your goal is to grow, then you really should be timing your exits so that you don't burn up too much lease term. If there's an opportune time where you still are in a lease term that is easily financeable, then you're going to have an easier exit, or at least a more favorable one when looking to, exchange into something bigger and grow. Does that sound right?
That is correct. Yeah. And there are investors who hold on to these assets for a very long time. And they pass it on to their heirs and who get a stepped up basis.
Now, great question from Troy. Let's look at the other side of that equation. Talk about the buyer of that 10-year remaining lease on the property. Now, how are you looking at that as an entry and as an exit?
Excellent question. That buyer could hold on to that asset also for 5 years. And when there are 5 years remaining and there's another rent increase in 5 years, then that investor can also place the property on the market at the same with the same conditions that we described earlier.
Nice. Okay. Now we've got, I'm sorry for everybody if we don't get to your question. We have quite a few of them here. I actually posted Armand's email into the chat. So if you click the chat button, you will see Armand's email there. You can email him directly if you have a question that wasn't answered here. I've also included my email as well. If you missed any part of this and you would like a link to the recording, send me an email and I'll get that over to you as well. We still have some time here, so we're going to get through as many questions as we can while we've got you. But since there is so much that we haven't been able to cover yet, hopefully we can get you back here for a part 2, hopefully sooner rather than later. We can invite everybody back and get through the rest of the talking points and questions that are here. I'm going to put you on the spot now in front of everybody.
Yeah.
Okay. So let's talk about this. Maria DeAngelis, for the investor that purchases a true triple net lease with a rent holiday after the initial term, what is the exit strategy for this buyer? So you buy a CVS, 20 years on it. At year 18, they stop paying rent. Let's say you're at year 16, right? So you got 2 years left of rent to be paid and then 2 years left of holiday. How do you position that? What is your exit strategy? Or are you even waiting until you get to the 16th year?
Excellent question. I think an investor who is looking to sell a rent holiday property should have at least those 3 years of rent that they are going to be willing to give as a credit to the buyer at the close of escrow. And that is just like any other asset. If there's 15 or 10 or 5 years remaining, it really boils down to the investor having the capability to give that 3 years of credit upon the close of escrow.
Got it. So it's negotiable, but
it is negotiable. Absolutely.
One of the ways that you find a way to kind of bridge the gap is you credit those holiday years to the buyer.
Yeah. So the net present value calculation, you do put that in the marketing material that the buyer will be getting a credit of the net present value of those 3 years of rent holiday.
Mm-hmm. Question from Fred here. Does the cap rate vary based on the type of property? For example, if you have a net leased industrial building leased to a public company, would the cap rate be different than a retail type building leased to a similar credit company for the same lease term?
That is a great question. The cap rates will vary across product type. If it's an industrial or a retail property, they just have their own market cap rate variance. If it's a retail property or industrial property, most of the industrial properties might be a double net property. So you will definitely see a difference in cap rate between the double net and the triple net. But I'm trying to think any tenant who does have retail and industrial space. I mean, I'm thinking of, what's that? Amazon, yeah. Their retail footprints are small, like their Amazon bookstores. Yeah. I'm thinking of like a Home Depot. Home Depot does have retail stores, and they also have industrial distribution warehouses. And those cap rates are different. Yeah, they are different.
Now, speeding right along here, we've got some more time to get some of the questions out. We actually had another one come in from Troy. So Troy wanted to know, how much of an increase in the cap rate can you expect in a decrease of term from, let's say, 10 years down to 5? Or what kind of cap compression or cap increase are you going to see in that 10-year tranche versus that 5-year tranche, all things being equal, right? And I know there's so many different variables that you got to take into account here, but let's just, take the exact same deal in your head, 10-year lease, 5-year lease. What kind of cap difference are you generally seeing today?
Again, it is a case by case difference, and I know you did definitely set it up that way. But there are a lot of factors that have to be considered case by case. What the sales are make a huge difference. But it really boils down to what the tenant is. If there's a specific tenant that someone has in mind, I'd be happy to provide a opinion of value for that. But it could range anywhere from the brand new property that would sell at a 5 cap. If that property has 5 years left on there, it might go as much as 100 basis points in spread on the difference.
Troy, I posted Armand's email in the chat there. If you want to send him an email offline, please do so. Again, I'm getting some messages from people looking for a recording. Send me an email, Yannis@Crexi.com. It's in the chat also if you would like a link to the recording when it's posted, and I will get that over to you. We will likely, it looks like, have a part 2 of this particular webinar, just because we're full. Actually, we had a tremendous sign up, and we've got a lot of questions here as well. So for anybody that couldn't make this one or had a question that wasn't answered, you can email Armand or stay in tune for a part 2 that we'll try to do. A couple of other really good questions here that I want to get to before we hop off. Bill Griffith asks, if a change if an election changes the country, let's say we see 1031s go away, stepped up basis go away, cap gains go away, how does that affect net lease properties? I mean, it's going to affect everything in a pretty major way, but what are your thoughts on how some of these things, these tools and things in the marketplace that we use, if they disappear, how does that change net lease?
Yeah, I mean, that is definitely a hypothetical. If it does happen, they have been talking about taking 1031 exchange out of the code, IRS code for some time, but it hasn't happened. But if it does, we still have a lot of people who want to sell an apartment property that has a lot of maintenance and a lot of repairs and some of the headaches that an investor might not want to deal with. There are investors today who have shopping centers that have a lot of local and regional tenants who are struggling, who want to sell those assets and buy a triple net property. So I'm very confident that we will still see a high number of sales and transactions into the net lease space because of the desirability of the rent collection and the ease of management.
Great. Quick. Let's say a change up here. This should be a really easy one. When it comes to reinvesting, should I be aware of high cap rate? In other words, if it has a high cap, is it more risk?
It is more risk. That's exactly why the cap rate is higher. Yeah. You have to see why it's being offered at a 9% cap rate. It might have 1.5 years remaining of term, and they don't know if that tenant's going to renew or not. So at that point, you really need to be underwriting the building as vacant property and what the market rents are and what kind of rent you're going to be able to replace. But higher cap rate, definitely more risk.
And Serena asks, any potential to auction off net lease properties? Serena, absolutely. Actually, on Crexi, we have auctioned off net lease properties. It is just one method of disposition. Auction has become a lot more popular, especially post-COVID for buyers. Buyers really like being able to, bid their number and be on an even playing field with all the other buyers. So it is possible to auction off a net lease property. If you have one that you'd like to auction, feel free to reach me via email. A couple more questions that we have here, and then we'll sign off. What kind of longevity do you think the dollar stores will have? From Barbara Dancy. I mean, obviously right now they're crushing it. They're doing excellent sales, both because, number one, it doesn't really interfere. Amazon doesn't quite tap into the dollar store demographic. But also with the pandemic, more people are, looking to dollar stores, which are open. It's an essential business. Let's say, a year from now, all things going well, we're out of this pandemic, everything's open. Do you think dollar stores are still going to have the kind of the zhuzh that they've got right now?
I really do. The dollar stores, Dollar General, just acts as a very general market store. They set up in areas where it's mainly housing and nothing else. So that housing community does have access to a store that has everyday items. They sell everything that any regular store would. So yes, I do see longevity with dollar stores in staying in markets even well after the pandemic.
Fantastic. And we're brushing right up against the end of the hour here. So I launched our closing poll. And I see we still have over 20 questions here that we weren't able to get to. I'm very sorry if we weren't able to get to your question. You can email Armond directly. You can go to the chat box. It's armond.aivazyan@marcusmillichap.com. Or if you'd like a recording of this, you can email myself, Yannis@Crexi.com. And we are going to try to bring Armond back for a part 2 of this so we can get to the rest of the talk track and hopefully more of your questions. Armond, thank you so much, not only for coming on, but for introducing me to Crexi.
Absolutely. Thank you for having me.
I'm very, very pleased that you were able to take the time to both educate us and answer questions. Any last thoughts before we sign off? I know you always were a good person to ask if there were any good podcasts or books. Anything that you're listening to or reading right now that's keeping your attention, real estate or otherwise related?
I'm looking for different podcasts. I think Data to Deals is one that I have been listening to that was pretty good. But if someone has any other suggestions, I'd be happy to listen.
Data to Deals. Excellent. Well, again, thank you everyone that tuned in. I appreciate everybody taking the time to come in and check out our Pro Perspective this week. We will try to bring Armond back and email all of you in the event that you had a question that wasn't answered. You can reach him or myself. Again, this is Pro Perspective, a look into all things commercial real estate. I'm your host, Yannis Papadakis, and we will see you again next time. Thank you.